Private equity's business model, also known as PE, is to take a floundering listed public company private, fix some of the problems, and relist these companies at a profit. Now, traditionally, this has been a very small part of the investment arena, but after the great financial crisis of 2008, when central banks instituted stiffer regulations on banks and bam, dropped those interest rates to zero, private equity exploded with all that cheap money, filling the debt creation hole left by retreating banks and also creating hidden risk that now has become a looming threat to the global financial stability. So while the public remains blind to the breakdown underway, the need to transfer this risk from the 1% to the masses has become imperative and urgent. And like the treasury market risk shift that's gone from governments and banks to the retail investors of mutual funds and ETFs, private equity is shifting from sovereign wealth funds and pension plans to affluent retail investors that are known as mini millionaires. Will this risk transfer happen soon enough and provide enough funds to hide the true lack of liquidity in these assets? Would the implosion of this asset class cause the next financial crisis and act as the first domino to fall? And by the way, are you ready for the impact? And this one you might not see coming, but there's a huge risk transfer scheme that is already underway. And let me show you what's happening in the private equity market, which is really quite an opaque market, and how that could impact you and me and everybody else. And could it take down this system? Well, it's roughly, by some accounts, it's kind of opaque. By some accounts, it's an $8 trillion market. By other accounts, it's a $12 trillion market, plus all of the leverage built into the system. And let's face it, last year, 2023, private equity's horrible, no good 23, set to continue into 24 because of the higher interest rates. You know, free money, that floats all boats, really. The pain likely won't end until central banks are really done hiking rates. And we know some things that are on the front to that. But many firms are likely to resort to financial engineering. This whole system is financially engineered. This is what adds to that income and wealth inequality. But what they're talking about is borrowing against their investment funds to gin up the cash. In other words, to create more cash that they need to buy more assets or, oh my goodness, return capital to investors. Ponzi schemes must always have new money coming in to satisfy whatever their needs are, including paying out those that are on the top, the sovereign wealth funds, the one percenters. Now, some will shuffle existing assets into new funds, effectively kicking the can down the road to avoid selling a company for less than they paid. Because when money is free, I mean, look at the valuations in the stock market, in the bond market, in the real estate market. And that is shifting with the advent of the central banks raising rates. But some investors oppose such transactions. Why? Because there's a potential conflict of interest when the buyer and the seller are the same firm. What do you think, you guys? So the interest rates that the Fed has now forced on the markets, has burst the debt bubble. This is also impacted by that. And what has been happening is that these private equity funds have been slow to return capital to pension funds and other key investors once reliable clients are maxed out on the cash they're willing to allocate to such investments. Have we not seen this in the treasury market, where the stable investors that really don't care so much about the day-to-day fluctuations, like governments, central banks, right, and the deep, deep pockets and commercial banks, well, you know, they had to transfer that risk from those few to the public, to the many. And this is no different. This entire system is a Ponzi scheme. This is not a Ponzi scheme. You hold it and you own it. So what's happening in private equity, which has exploded since the great financial crisis, large backers of private equity are asking for their money back. That's a deep problem. Sovereign wealth funds and others want to unlock their previous investments before putting in more money because private equity is usually not liquid. It's not a liquid asset. But in the reach for yield and zero interest rate policy, it's become a hot commodity. So one commonly used justification for LPs or limited partners, so these are the investors, asking for cash back is the so-called denominator effect. What's that? Well, that's where the value of the assets from real estate to public stocks have proven volatile in recent years, and private equity valuations have largely remained steady, at least on paper. So these private equity firms, kind of like Bank of America saying, well, if we hold these treasuries to maturity, we don't have to take any losses. Well, in private equity, they can say that this widget is worth anything, or this stock or this real estate is worth anything. It is not based on current market valuation. It is based upon whatever they say, and it's opaque. And these limited partners, these LPs, really don't have much say in what happens at this point. And when they were making lots of money, who cared? You didn't want to say. Now the tables have turned. But the balance of power is shifting within, they're saying, the $8 trillion private equity industry as buyout funds struggle to return money to investors amid disagreements between buyers and sellers over corporate valuations. Wait, we want to know how much our investment is actually worth if you are forced to sell. Well, they can't at this point. The limited partners cannot force the fund to sell. Can you see the looming problem? Can you see the battle? Because that's handing more power to limited partners to dictate the terms of the engagement, and they want more transparency. They want more say. And I'll show you why. Just hang with me here. You definitely have to see this. Private equity business takes companies private, then sell to market for a profit, okay? But the fundraising slows. So again, in every Ponzi scheme, you have to keep getting new money in. And investors are turning cautious in private equity. So while it exploded, right, since the arena of 2008, once the Feds shifted their zero interest rate policy, so did the ability of that free money to flow into the fund. And what we're seeing, there you go, is that it is now near the lowest level ever. And 2010 was a pretty tough environment, if you guys remember correctly, because private equity relies on cheap leverage, and higher interest rates are limiting institutional investors' appetite for the strategy, making it more urgent to find new fields to plow. In other words, new investors are required. Now you're talking about very sophisticated investors that were going into that. But now they see what the problems are. They're not getting their money back. They have no control in these markets, and the markets themselves, the valuations are imploding. So how can they transfer that risk? And who can they transfer that risk to? And before they transfer that risk, how can they make their assets appear to be on solid ground so that they can attract those new investors? Like maybe you? I hope not. Private equity is piling debt on itself like never before. Shocker. Private equity firms have been increasingly adding another layer of debt to their complex borrowing arrangements. It's not clean cut. It's not obvious. It's complex borrowing arrangements, raising concern among some investors about potential risks to the wider industry and the financial system. You think? Because the investor universe is unbelievably unaware of the underlying leverage throughout this entire ecosystem. Now look, leverage works great in a debt-based system when everything is on the way up. But when the implosion occurs, all that wealth transfers. Now, frankly, if you are in the right place at the right time with the right asset, that will benefit you. That's part of the strategy. That's just based on repeatable patterns in history. But yeah, it's so complex. And what do they say? Even the big guys, they say, if we make it really complicated, nobody questions us. Well, trickle down. They made it really, really complex. That hasn't hit the private equity investors yet because they're stating how much the valuations are. But the investors are starting to question that now. But it's becoming more clear for real estate investors, and that is going to trickle down as well because a lot of this private equity is based on commercial real estate.